You're watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today, Devin Shutte from the Robey Group and Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for joining me this afternoon. Before we get started and look at the questions, I just want to get your overall assessment of the trading week that was. It really was a busy week. Traders eyeing developments on Trump's trade policies. We've also been digesting a lot of company earnings. And then later today, we have the US non-farm payroll numbers out. Roy, let's start off with you. What have you made of trade this week?
It's been, like you said, it's been a volatile week. And I think we started getting a few more insights into Trump's psyche and what exactly he wants to do. Well, we know tariffs are a huge part of it. Now we see precisely how this functions, almost like threatening people and then pushing back or having discussions. I think the most shocking thing was the whole story about moving the guys out of Gaza, the Palestinians out of Gaza into other places. So I think it's just exemplary of what we've been saying since the beginning of the year, that we're going to have a lot of volatility, a lot of left field proposals, and yeah, very difficult to see over what's going to happen over the next few months. From a macro perspective, I think very much in line, except I think earnings in the US were not as strong as people expected. It looks like there's a bit of a peak that's coming through. And from a macro perspective, I think the non-farm payrolls this afternoon will tell us a whole lot. So yeah, lots to chew on, to be honest.
Roy mentioned something important there, Devin, around the earnings. I've been looking at a lot of the earnings coming out, and one of the most consistent headline is the missing of expectations, the missing of revenue expectation, profit expectations. What did you make of trade this week?
Yes, I mean, I think volatile was the perfect word for it. And yeah, I mean, I think there's a whole lot of factors that tie into it. If we look specifically at earnings to your question, I think what you're seeing there is potentially in some segments of the market, particularly US large cap, that those expectations have been incredibly high. The valuations are looking somewhat stretched. And my sense is that there's the potential for somewhat disappointment as those higher for longer interest rates start to bite, as maybe the growth trajectory in the US is maybe not quite as high as we think. We had some indications this week as well that the US labor market could be softening. So we'll wait for further confirmation of that from non-farm. But yeah, I think it's probably the easier glide path for earnings growth is probably behind us with last year. And I think what we've got now as investors is a much more short-term focused, volatile environment. And that's not particularly great for investors. We like these, we like certainty. And so as a result, I think you're going to see with the flurry of executive orders and things changing so fast from the US administration, I think it's going to create a heightened sense of volatility, and I think that's going to potentially feed into earnings through the course of this year.
Interestingly, our first question is on US tech stocks, and the viewer says, I've invested in a few top tech companies like Google, Apple, Microsoft, Visa, Meta, and MasterCard. These companies have done extremely well over the past few years. Do you think it's likely that tech companies will continue to outperform other industries over the next 15 years? Roy?
An interesting question. That's actually the million-dollar question.
Yeah.
And I think the way to examine that is to see which ones of them have this sustainable competitive advantage and which ones have what you might call a moat around them. So a lot of them have grown through network effects, which means if I use it because a friend of mine is using it or brings us together. That sort of a company can continue growing. What we've seen, however, is a lot of these companies were developing an edge using AI, and the big nuclear weapons there were spending on AI and CapEx, increasing their capability. But what you've seen, I think between this week and last week, is that AI doesn't have to be that expensive. You don't really need to spend that much money. So maybe some of the second and third tier people can use the AI tools, the cheaper AI tools, to close that gap. So it doesn't necessarily take away from the incumbents. It just means that the growth runway maybe gets a little bit contracted. And then you have to be very careful about what price you're going in. I think the listener probably says he went in at very cheap prices. But starting from here, looking forward, I think it would be unreasonable to expect the sort of returns that you saw in the last 10 years, in the last 5 years from these companies. You're probably in for a period of muted returns, increased competitiveness, and I think a diversion in business models as this whole AI story pans out. So I think, long story short, these are solid companies. You have to be very close to them, but don't expect a repeat of the last 5 years.
I see you nodding your head there, Devin. Do you share the same sentiments?
Yeah, I think Roy put it well. I think when you're entering any investment, the more you pay from a valuation perspective, the more you've got to be sure that the future of that business will play out positively the way you expect, and the higher the risk that it doesn't, and you end up being disappointed and you make losses on your investment. So what we've seen is a real golden age for these large companies that the viewer is alluding to, where they've just continued to assert their dominance. Margins have been expanding, and they've really benefited from probably an era of cheap money and asserted themselves on the global financial stage. I mean, we've got a very concentrated global equity market at the moment, with the MSCI World being 75% represented by US equity. So yeah, I think you've got to be quite circumspect. I don't think just chase them because they have done well over the last 10 to 15 years. I understand the business model as well, as Roy said, and there will be winners and losers. I think these companies won't lose their dominance overnight, but you've got to be very careful if you start to see some of the margins being eroded. An example could be NVIDIA with the Chinese AI and DeepSeek coming in. But then you've got companies like Meta who are using AI to expand advertising margins very, very effectively. So, yeah, I think no broad brushstroke statement will encapsulate it. I think it's very much on a stock-by-stock basis.
All right. The next question here is on Intel. It reads, is Intel dead and buried? Devin, your take on that?
Sure, it's not one we've followed so closely, but
Okay.
I will say, with Intel, AMD, or the like, you're a distant second to the behemoth that is NVIDIA.
Yeah.
My sense is that they will close that gap somewhat, but the leadership that NVIDIA has demonstrated, and the sophistication of their GPUs has just been so far beyond everyone else's that it will take time. So yeah, I'm not really in favor of chasing that. There's a big implementation risk that they don't get it right, and I think they've lost a lot of ground. So yeah, for me, quite risky. I'd err on the dead and buried side.
Roy, the group did release results about a week ago. Guidance was weak, but sales for the fourth quarter came in better than expected. Your take on Intel?
They've really struggled.
Yeah.
There's a new incumbent, there's a new kid in town, and these are the champions from a long time ago. Once that innovation cycle passes you, it's very difficult to catch up. I mean, I can see they're highly geared, share price has halved, outlook is just getting worse. I think the advantage is with the current players, with NVIDIA and the like. It's very, very difficult to close that gap without a massive transformation of your business and your business model. And that's highly risky. I think I would agree with Devin there. This is probably this is a yesterday story, not a tomorrow.
So it's not a case of it's going to get worse before it gets better. We must just maybe forget about it?
We can't tell what the better will be. That's the problem.
Okay.
Because the innovators are so far ahead, and the difference, like I said, the nuclear weapon here is the capital to innovate at the cutting edge and keep producing these chips that everyone wants.
Yeah.
Once you get left behind, it's very difficult to close that gap.
Let's take a look at miners. We had the Anglos group out with updates yesterday. And the question here is on Anglo American in particular. It reads, I am hopeful about Anglo's restructuring plans. Would it be the right time to pick up some Anglo, or should I wait until the unwinding of its non-core assets is done? Devin?
Sure. Tricky question. That to be prudent, I would say wait. You know, there's a lot of moving parts at the moment here in a conglomerate like Anglo's. The real big kind of albatross around their neck is De Beers. They continue to warn how they're going to have to impair that asset there. I think they were considering a separate listing at one stage, but because that diamond market is so depressed, I think they shelved that. There was just, no opportunity to really gather, gain any value out of them. Platinum's a tough place to be at the moment. Kumba showed some weakness there, and particularly with the logistics problems we have here. So, yeah, I mean, I think if I were the listener, I would definitely wait and see if the restructuring is effective. These things can work. We think back to Billiton, through a couple of years ago, did it effectively, but it's very, very big implementation risk. So, yeah, I'm waiting to see, and my advice is probably to do the same.
All right, Roy, I'll give you another question. Looking at gold miners, the viewer asks, what is the panel's view on DRD gold? Is it a buy at current levels?
So DRD has gone through quite a lot of restructuring. Remember, they've got the deep level mines, but they've also now started doing the dredging of the old reserves, which is much cheaper, a lot safer, and has higher margins. And that's why you've seen their competitor, Pan Africa Gold, doing particularly well. I think in more recent times, you've seen the operation improving. But I think what the listener needs to be very careful about is it the gold investment you're looking for, or are you looking for a turnaround in the company? And because those tend to be very different things. You find that a lot of the times the company's share price doesn't reflect the entire run in the gold price when they're actually supposed to be leveraged. And sometimes business model issues in the company may drive that underperformance a little bit more. If you want less risk, if you want pure exposure to gold and the run up in gold, then you buy gold. If you want leveraged, risky upside, then it's one of the gold miners. Remember as well, being South African, there's a rand exposure, there's a rand gearing, there's all of these drivers that you need to be very comfortable with.
One that seems to be a fave, one that's on the radar of everyone, is Novo Nordisk. And we have a viewer here asking whether the share is one to invest in for the future. Let's start off with you, Devin.
Yes, I mean, Novo Nordisk, you're buying a pharmaceutical company here that's developing a whole lot of cutting-edge drugs, in particular one to deal with diabetes. I think, unfortunately, it's come off the boil a bit in the last year. I think there's a number of potential factors for that. One is that the regulatory constraint in businesses like these and getting approvals in various jurisdictions is incredibly difficult. Two is the efficacy of the drugs. Sometimes those do come under question. And then also the intense competition in the space as well. You think of the likes of an Eli Lilly and that. So it's in my mind, these are kind of higher risk investments. Your cash flows can be rather lumpy, but there's no doubt that being one of the first movers in the space, that they've been able to command decent margins in that regard. But yeah, there's definitely a risk on that. So I think one to be cautious on, but looking a lot cheaper than it was a year ago.
And which one do you prefer, Devin? Eli Lilly or Novo?
So I'd probably go Eli Lilly
Okay.
if you had to push me for it. It's not one that we currently have exposure to. It's still been a very volatile ride in that regard, and you're paying incredibly expensive multiples for these. But I think you're seeing more investor support for Eli Lilly in the recent past.
Let's get your view on that market, Roy. Novo Nordisk or Eli Lilly?
So what's driving the two of them right now is those GLP-1 drugs, which are basically drugs that help people manage weight loss. And it just seems to be a completely insatiable market. I mean, Novo Nordisk did sell off. I think it's off something like 40% of its peak. And that was when people were concerned that demand was coming off. But Eli Lilly came out and showed in a presentation that demand is still there. In fact, they're still on the US drug shortage list. And even despite people coming up with the post patent products that compete with them, it just seems to be a huge market. So these pharmaceutical companies depend on producing through patents and after patents.
Yeah.
Both of those companies have shown that they've got a nice pipeline of products that they can bring out. It's just about how comfortable you are with the level of valuation, first of all, and secondly, what that pipeline does show. I think investors have shown that they're very confident that this market can continue to grow, and the evidence is there. So I'd be very, yeah, either of them would do actually. Both of them play to pretty much the same thing. Novo sold off its peak, so maybe that's one to look at. But once you're comfortable with GLP-1 specifically, that's going to be the big driver over the next few years.
So confidence coming through on that GLP-1 market, that weight loss / diabetes drug market. How do you feel about the beauty industry?
So beauty is interesting. It's generally low margin and it's used in retail as almost, I wouldn't call it a loss leader, but it's like the window into a retailer.
Yeah.
But like I said, it's low margin. It's most popular when economies are recovering because people want to look good, going out for interviews, going out for interactions and all of that. So it tends to be quite cyclical. There's a component of it that is quite defensive, but low margin, but quite cyclical. And you've seen some of these beauty companies really struggling and losing money over the short term. So yeah, I would say it's a function of where the macro is and where global growth is and consumer discretionary purchasing goes.
You're absolutely right. We've seen those stocks under pressure since about COVID, and they're just really struggling to recover. Devin, there is a question on L'Oreal. Are you seeing value in that counter? I think they were out with results yesterday as well, hey?
Yeah, that's right. Look, the share price has been under pressure for the last 12 months or so. It's down by about 25% there. I think the company was fairly bullish on the US outlook, which makes complete sense. That consumer probably in better shape with most. But China was really a weak spot, and that's an area that they have wanted to rely on. And unfortunately, that dragged down their quarterly sales there. So yeah, I think they've also made a few small investments in other luxury brands. But to Roy's point, very thin margins here and a difficult old space at the moment, particularly where the global economy is.
And how does it fare up against, let's say, an Estee Lauder?
So Estee Lauder, similar in terms of the margins that you're looking at there. What you've got from share price performance is Estee Lauder for a number of, I think, company-specific reasons. I'll have to go into the detail, but they're down a lot more. Probably they've halved in value over to cut jobs and the likes. So yeah, I think Estee Lauder got a lot more work to do, probably due to the portfolio of brands in there. But yeah, just a difficult space all around.
All right, let's move over to another question. Two questions from this viewer. I'll start off with you, Roy. Can the panel please give their inputs on Mondi at current levels? Maybe let's talk about Mondi and look at how it fares up against Sappi.
So Mondi, I think if you ask any fund manager out there, they'll tell you Mondi is probably the quality play here in that specific industry. It's sold off over a period of time. It looks very cheap as it stands right now. But I'll caution, Mondi depends a lot on economic recovery because a lot of what they sell is basically corrugated boxes. So that is a market that picks up when the economy is picking up, particularly in Europe. And that's not something that we've seen recently. So you put on one side the macro outlook being weak for them, and on the other side, a good quality management that's invested well historically, that has good facilities, generates cash, solid business, and low valuation. And then you have a balance there. So it's not one that's going to double tomorrow. It's probably one that if you got in right now, you'd be getting in at the bottom of the cycle, and you'd have to hold for the time when that whole economic recovery begins, particularly in Europe, and you'd probably be rewarded from that.
You know, Roy, talk to me about some of the sectors or perhaps the counters that don't rely mainly on a recovery, right? We do know that the tech sector booming, but other than that, what other sectors can we look at getting into?
I think so there's consumer staples,
Okay.
which basically is stuff that you and I need, regardless of what the economy is doing. So that's good. The food sector as well. So domestically, that would be companies like Bidcorp,
Yeah.
who operate internationally, and their food, then food distribution. It's that sort of thing that you'd be looking at. Those are defensive plays that tend to have low gearing on the balance sheet and are geared towards consumer needs, not consumer wants, but consumer needs. Those are that's probably where you want to be. Another one typically could be telcos, particularly in emerging markets. Actually, even in developed markets, they've got lots of capex requirements, but data is critical in everyone's life now. So those are less cyclical than consumer discretionary, where if we're happy and we're confident and we have income, we spend a whole lot more.
You look at Bidcorp and you look at Bidfest, those share prices have really been running. Let's get into another question. Devin, the viewer says, I've been holding on to Santova shares for roughly a year and the share price has gone nowhere. I'm thinking of offloading them, but my second thought is maybe it's only the start of a better cycle for the company. And the viewer's just asking for your thoughts on that.
Yes, so I mean, not the biggest company, probably about R1 billion in market cap. And what this company does is it's a non-asset based logistics company. So they've got software where they try to find smart ways for companies to move goods across the globe. And they've been fairly effective in it, but unfortunately the market hasn't really given them much credit over the last 2-3 years for that. So, the company trades on around 7 times earnings at the moment since we're going sideways. My sense is if the viewers in it, they can hang on. I don't know if I'm expecting a massive recovery in it, but I don't think that there's been massive missteps in the business. I think they've kind of stuck to their knitting and done what they've done well. But, it's a small liquid company and that comes with its own risks in itself. So my sense to sit tight, but I think it's still going to be a fairly muted path forward.
All right, let's just get one more question before I get into your stock picks. The question reads, I've noticed that many South African retailers like Spar, Shoprite, Woolworths and Pick n Pay are currently trading above their initial public offering prices. Given this trend, is it realistic to expect Boxer's share price to surpass its IPO price of 63 Rand and reach over 100 Rand within a year? Devin, I'll start off with you.
Yeah, look, so I mean, Boxer, and it was kind of to Roy's point earlier about these more defensive companies, I would put Boxer in this. It really has been a successful listing. And yeah, their results as they've released for 45 weeks, they've seen really nice growth coming through there. Pick n Pay had to spin them out. Gross margins are pretty decent there. And so, yeah, I mean, I think it's a quality business, maybe a touch on the expensive side, but I think SA food retail is kind of in line with the peers there. So, yeah, I like it. I think the market is being receptive to the business case here, and I expect kind of over a longer term view, the company will continue to do well.
Roy, are you just as upbeat on Boxer?
Oh, yeah, absolutely. I think they're big. In South Africa, there are few companies that you find that have secular volume growth stories that extend over the next few years. These guys are expanding space in a market that is not occupied right now by any big incumbent. They're at the low entry level of the market. They've got a very clearly defined business model and they know exactly where they're going to grow into. So no, I think it's still early days for that one. And I think it's important for the listeners to also understand, give management time to execute on their strategies, to grow into their markets, and you'll benefit with them. I think a year is a very short period of time to change, to convince yourself about any one investment case. But I mean, when I look at this one, this is perfect for South Africa. It's a perfect investment that over time will give you returns.
So we seem to have eaten into our time. So I have 30 seconds for both of you to give us your stock picks. Roy, let me start with you.
My stock pick this week is Renet. That's RNI. That's that vehicle that the Ruperts have. You see, every so often you pick an event-driven model. So effectively what they've done is they've sold their BAT shares. So that company only has cash, maybe about 30% of its market cap, and Pension Corp, which is actually quite a solid business. I think over the next 12 months, they'll do something with that cash. What they've shown is that they're conservative and they tend to do really good deals. So either you as a shareholder will get it as cash, or you'll get a bigger shareholding in Pension Corp, or you'll get another more interesting investment there. So I think there's opportunity there for where the valuation is right now, the outlook and the quality of management.
All right, Renet for Roy. Devin, what are you hanging your hat on today?
Sanlam is one we've chatted about before. We spoke about expensive US tech, and so what you can get here as an investor is very what I would argue is cheap tech, and that comes out of China. There's an ETF that encapsulates the China internet, KWeb, and here you're getting a basket of tech shares that are looking very unloved, but doing incredible things. And with the AI race really heating up, DeepSeek, Alibaba, and a number of others are launching really credible alternatives. And yeah, I think it's a nice way for investors to get exposure to that sector.
Gents, thanks so much for joining me today. Thanks to my guests, Devin Shutte from the Robey Group and Roy Mutooni from Sanlam Investments. Remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind when you send through your questions. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.